The new pension system has been in the news recently, with some states demanding the restoration of the old pension scheme and others going back to it. Outlook Money caught up with PFRDA Chairman Sudip Bandyopadhyay to understand how NPS works, the types of guarantees and tax benefits it provides, and what's behind the consistently high performance of its equity schemes.
If you look at it, these two schemes, the old pension system and the national pension system, NPS as we call it, these are not comparable in the sense that in the old pension scheme there was no funding concept, and it used to give a defined benefit at the retirement of the person. Say 50% of the last drawn pay will be given as a pension. But whereas when government adopted the national pension system way back in 2004, they thought that it has to be a defined contribution system where both the employer and employee will be knowing in advance how much is the financial commitment. And this is the way world over the pension schemes were changing at that point of time. And as we look say 18 years down the line in 2022, a large number of countries, including advanced countries also, they have shifted from these defined benefit schemes, which is akin to our old pension system, to the defined contribution scheme, which is in nature of NPS. It's because these old pension schemes, since it was unfunded and the money was going from the coffers of the government, from the revenues of the government concerned, they found in the long term it is unsustainable, financially unsustainable. So, from an unsustainable situation, we have come to a situation or a pension system which is sustainable over a long period of time. Any defined contribution system which is available anywhere in the world, defined contribution system does not give a guarantee, but what it really gives a kind of guarantee that pension is there at a later point of time also, and it will not create unusually high say financial burden on the any government of the day. So, what we have done in the NPS system also, we have kept a lot of flexibilities, is that if the person wants, he or she can take the 60% withdrawal at one go, and the annuity part, which is the 40%, remaining 40%, that can be deferred by 3 years. If he wants, he need not take anything from the system at all and continue for another 15 years also, even after 60, if they feel like that. So, to avoid this kind of volatility and to see that in a volatile market condition also I do not have to go out of the system, these kind of flexibilities are already given in the system. In the long term, we see that these market linked schemes, they definitely give a much higher return. Like even if you look at our equity schemes, for 13 years now that we are running it, since 2009, pure equity schemes, it is giving close to 12.5% of CAGR, and that too we are going into most of the blue chip companies. We are not going into mid caps and small caps in any way, but despite that we are giving this kind of returns. Our corporate bonds are giving almost close to 9.5% of CAGR. Even government securities, where the yields have hardened last 6-8 months, as you have seen, there also it is more than 9.1, 9.2%. So, if you look at it, any market linked scheme over a long period of time will definitely give you better returns. Yes, volatilities are there, volatilities will remain, and especially the kind of geopolitical situations that we are seeing now, volatilities will be even more. But there are ways of coming out of these volatilities, is that the person need not go out of the system immediately, they can wait. Now, one thing that is definitely working is that the quality of the fund managers that we have chosen. So, our entry conditions are a little that way stringent to ensure that only the very strong sponsors they come in and they float their pension funds. And the pension fund managers, they are also recruiting good quality people with excellent track record from the market to manage these funds. So that's why we have seen that over a period of time the returns have been quite good. Secondly, the kind of investment guidelines that we give to the fund managers, we also ensure that they put their money in the quality stocks, or even when they are putting the money in the corporate bonds, they put in only quality corporate bonds, and they do the research not only in the track record of the company but the corporate governance and other things also, to ensure that the money is being put in the right kind of instrument. So I think it is a combination of all these things that is giving this kind of a return. That's an interesting product, because in 2013 when our act came out, PFRDA Act, actually part of the act says one condition was that there has to be a product which will give some minimum assured return. So we have been working on it for quite some time, but initially our discussions with pension fund managers, the result was pension fund managers said that we can give only capital guarantee. But nobody really, no customer or no subscriber will come only for the capital guarantee part of it. So then we thought that better to take the help of a consultant and actuarial firm. So we have selected a consultant through a RFP process. Board has already just recently given approval. We are working out with them. So maybe in next 6 to 8 months time, minimum assured return scheme will be there. What will be the kind of guarantee? It's difficult to say at this point of time, but basically what I feel under this kind of a volatile market condition, what we can look at is a floating kind of a guarantee which is not fixed. Telling that I'll give a 5% return in a market where say 10-year government bonds are close to 7% seems okay. But when the government bond returns will come down closer to 6% or maybe 5.5%, then it will be very difficult to maintain that guarantee. So instead of giving a sort of a fixed kind of a return, we are thinking of a floating return. The return which will vary maybe according to our market benchmark, say maybe 1-year T-bill or 1-year government bond kind of thing, and it will be reset every year. So all the possibilities we are looking at, and our pension advisory committee is also looking closely with this consultant to come out with a product. I believe it will be a very, very interesting product and customers will be happy to look at it. In an uncertain market, normally a lot of people will look for guarantee. In insurance companies also, whenever we had come out with guaranteed products, my earlier experience says that we used to get a huge response. So similarly here also, hopefully there will be good response to that product, and that's why I feel for a section of the pensioners, those who do not want to have this kind of uncertainty in their portfolio, for them definitely it will be very good. Annuities actually ensure that there is a regular sort of income post retirement, and for which a pension scheme is initially designed. Because if it is some other scheme, not a pension scheme, yes, we can give the entire corpus at one go, or we give them early access to the fund in a big way. But since it is a pension scheme, we have to ensure that when the person retires, there is some sort of regular income given to the person to take care of their needs at that point of time. So that's why this 40% annuitization, that provision is there. I understand this is taxable, so that becomes little difficult for the annuitants to manage their expenses and all that. But yes, in our proposed PFRDA amendment bill, we have kept one option that apart from annuities also, there will be systematic withdrawal plan or other annuity payout options. So as and when it is passed by the Parliament, we will be working on that, and we will see that there are other options to the annuity. Because one small issue that people point out with annuities is not that it is guaranteed over a long period of time. In fact, that is very strong feature of the annuity, but the rate of return that annuity gives. So, currently maybe annuity at the age of 60, which assures that on the death of the annuitant the entire corpus will come back to the legal heirs or the nominee, is just about 6%. And of course, once the 6% that is fixed, it remains forever. And these annuity rates also vary according to the interest rate situation in the market. So, if the interest rate goes down, obviously the annuity rates also will go down. So, we are trying to give this kind of options like systematic withdrawal plans or other annuity payout options also. So, once our amendment bill goes through the parliament, definitely we will look out into other options. Actually, here ma'am, I have a little different take in the sense that I also feel that NPS also enjoys the EEE status. Only thing is that at the point of retirement or at the point of exit, we do not give access to 100% of the money. 60% which is given in hand of that retired person is absolutely tax free. Secondly, 40% which goes to the annuity service provider is also going tax free. We are not charging any tax, no TDS is there. And in fact, the amount 40% which goes in buying the annuity, it does not incur any GST. Whereas in insurance companies, if you go and buy an annuity, it will have a tax impact, GST impact of 1.8%. So, that is also not there. But what is the outcome of the annuity is taxable. Now, if you look at EPFO only change is that 100% is given tax free to the customer, but the customer will not retain that account amount in their this thing savings bank account. They will invest it somewhere. The moment the investment income comes back, again that is taxable. So, here you only look at it this way, that 100% is given back, 60% in hand and 40% in terms of annuity. Whatever is the return of annuity, that is taxable. So, that is how I feel that this is also a scheme which has a EEE status. Only thing is that you do not have access to 100% of the fund. Actually, NPS, if you look at it, it seems that it is only one product, but the kind of flexibilities that we have added over a period of time is numerous. Like the investment options, the customer has huge number of investment options. Like if somebody wants to take risk at the age of say 25, 30, somebody is joining young and risk appetite is high, they can go up to say 75% in equity. Similarly, if somebody wants to stay safe, they can put even 100% in government securities. So, all the options are available. You can change between the options, like investment options. Earlier we used to give two opportunities a year. Now we are increasing it to 4 times. If you want to change your investment options, you can change it 4 times a year. If you are not happy with the fund manager, you can change the fund manager once a year. Similarly, we have increased the age at entry from 65 to 70, and you can stay invested up to the age of 75, and you will be happy. Just 5 months back when we introduced that 65 to 70, more than 2,200, 2,300 people in the age group of 66 to 70, they have come and joined. That means this demand is there, people are becoming aware and they are coming and joining. The biggest issue that we encounter is the awareness amongst general public about retirement income, old age security. These are the things people normally at young age do not want to discuss or think about. They feel that these are the problems for future that we can postpone. But through your channel and through this interview, I only want to tell the public in general that we have to encounter a huge amount of longevity risk in future. people today at the age of 60 are living for another 18 to 20 years, and that's the average that we see in India. And as the medical sciences also advance, lot of newer kind of treatments are also available, so people are going to live even longer. But there are costs associated with this longevity that people have to encounter over a long period of time, even post retirement, when the salary check is not coming. So one has to be prepared for that, and with the joint family system now breaking down, I believe everybody is on his or her own, and we have to start now and start early. See, if you look at the specific tax benefits of NPS, there is one exclusive tax benefit which is under section 80 CCD 1B of Income Tax Act, which gives 50,000 additional benefit if you invest in NPS Tier 1. Tier 1 is the main NPS account where you have to put your money once you open your NPS account. And this exclusive benefit, of course, it is only for NPS, it is not available anywhere. Apart from that, the benefit under section 80 CCD 2, which says that if the employer also contributes to the benefit of NPS in Tier 1 for the employee, up to 10% of basic, whatever the employer is contributing, that is not taxed either in the hands of the employee as perquisite, or it is not actually employer also is going to get tax benefit out of this as a business expenditure. One more thing that I want to focus on is the Tier 2. Tier 2 is an optional account which one may open, may not open, but it gives lot of flexibility in the sense that you can withdraw the money at any given point of time. And recently we are going to introduce one more change, of course subject to board approval, is that we are allowing people to go up to 100% in equity. Of course, it is subject to board approval, as I said, because it is an optional account, and we got requests from customers that why don't you allow me to put 100% in equity in Tier 2. So people, those who have very high risk appetite at young age and they want to get the benefit of the equity market, will allow them 100% equity investment in Tier 2 also.